Good afternoon, ladies and gentlemen. Thanks for coming to this little session of mine. Normally I'm a charting person, but there's always an element of reality thrown in there on the side. Probably you've seen me babble on TIP TV about more macro matters as well, but it's difficult to isolate, in many cases, price action from events in the real world. One of the most interesting factors, I suppose there's a few interesting factors at the moment affecting the markets. The December rate hike, which people seem to be equally divided in terms of there being one or not. Probably the reality is it's not actually going to be a big issue one way or the other in terms of the economy, but it may be an issue for the stock market. Also, obviously, we're in the run-up to the presidential election. I'm going for Donald Trump as the winner there. I don't think I can face another Clinton in the White House. An issue close to my heart is that of migrants and ISIS, a double combination, double whammy really. We're in trouble with both parties, each as a result of the other. And then also the big sort of the chronic problem that there is at the moment, deflation, modest or no growth in many Western countries, and sort of a Japan-style QE nightmare. The other thing which is affecting stocks, many of the stocks that I like, is the commodities collapse, both in oil and gas, and obviously gold. Gold sort of collapsed again on Friday, so and that doesn't seem to be any end to that slow death type of situation. So those are the big five general factors that I'm looking at, and they do affect the way I look at the market. In the UK, I'm fascinated by Jeremy Corbyn and how many more days he's got to be the leader of the Labour Party. I did actually like he's sort of quite an individual in terms of his style, and is not bowing to the Queen, or hardly bowing to the Queen, and other views on war and things like that, which I think is interesting. At least, as I said, in that he dances to his own tune. Then the other situation, as we saw with the autumn statement, we've got George Osborne really trying hard to become Prime Minister. He probably make it after the tax credits U-turn, which could have been this government's poll tax, but it managed to get out of that. Housing bubble still going to go on. And Mark Carney was brought in there 5 years ago by his good friend George Osborne. Gets £1 million a year for not raising rates, which he's managed to do so far. Then there's the deficit. Getting back to my migrant point, I think 360,000 new people coming to this country over the last year. I can't believe that doesn't it was not causing the welfare state to go bust. And also the strain on the education system, infrastructure, etc., is a total nightmare. And I don't understand why the powers that be are not acknowledging that problem. The other problem is the financial over-regulation, or inappropriate regulation, I think, destroying the city, which is our golden goose, and obviously fining the banks every other week. First market to look at in the wake of those comments, the S&P. Really, if there was going to be a crash for the equities market, it should have happened in August or September. We had that vertical drop there from 2100 down to 1850, something like that. The retest in September took us back to 2000, and from that point, really, there should have been a new leg down. Somewhere here by October. Instead, we got exactly the opposite of that. And for me, that pattern there below 2110 is an inverted head and shoulders, or a double-headed inverted head and shoulders. And a break of 2110 would be the big trigger to a massive rally. Obviously, with charting, you've got to wait for levels to be broken. If we don't get through 2110, then the bets are off on the buy side. But this time of the year, November, December, the strongest part of the year historically, and it's going to take a lot for that not to be broken and for the S&P to go up possibly 200-300 points. I mean, given my views on the Fed, which are that the Fed is not going to raise rates in December, that would tie in really with a break to the upside, because if they don't raise rates next month, it's going to be very difficult for them to do that. Just looking at this little dip here and the dip there are sort of that's the two sides of the formation there, so the mirror image of each other, and the target there is just the depth of that 250-point dip. So that takes us to 2350 if we break 2110. Closer to home, let's get that. The FTSE 100. I think we've actually just broken, or near to breaking, that 6,400 level on Friday. I wrote this report on Wednesday, I think, so it's a couple of days out. But 6,400 break probably takes us back up to 66.28, which is the 200-day moving average. There is a problem of the commodities stocks holding back the FTSE, but I think the rest of the market will probably take up the slack there. And as I said, if there's no interest rate hike in December, and with also the ECB, new QE from the ECB on December the 3rd, I think that this will be bullish for the market. Only really back below, let's say, 62.50, the 50-day average, that's the blue line there, would be a negative for me on the market going up. Gold was 1070 in the middle of the week. I think we're down towards 1055, something like that now. I mean, it's amazing to believe how bad this commodity's behaved over the last 3-4 years. The technicals, you just see this sort of these rallies to the 200-day moving average. That's the black line there, $1,156, and the trend channel there quite clear. If you're a fan of gold, I would say that even if it's going to eventually recover, or this is we're near the bottom, 1030, 1040 would be the support line there. So we probably have to head there first before we go up. But in a deflationary environment, and if gold couldn't go up in the 3 or 4 years of near zero interest rates, it's going to be really difficult if they do actually go up, or if we're in a cycle where they're going to go up next year or the year after. So big problems there. What might save it and give us like $100 on the upside again is if the Fed doesn't raise rates next month. So that is my view there. Crude oil, a bit more complicated. Goldman Sachs looking for $20. The other fundamental point to note here is there's like a 3 billion barrel surplus or glut of oil around the world. Clearly there's been dumping of crude oil in the market, and without overhead really, I think the best we could see here is $50 or $60, let's say on some geopolitical nightmare, but otherwise probably doing what gold does, as gold has been doing, which is basically a slow death towards $40, $30 to $30 to $40 over the next year. I don't see much upside there. Bets would be off here really only on a sustained push through $60. I don't think there's any point trying to be ambitious on the upside there. Right, those are the big markets. Next up, and for the rest of this presentation, it's the small cap stocks. I got into them 3 years ago now. The first company that I looked at then, I used to look at basically FTSE 350 stocks. First company was LG, well, it was called Lenny Gas and Oil. The shares were 0.6 pence in October 2012, and I just noticed this pattern here, bull flag on the 50-day moving average, and I thought, well, that looks quite positive. And obviously it was positive because the shares basically tripled after that, and that sort of got me into the whole small caps charting. And I don't think anybody else, even now, there's hardly anybody else around the place who dares to chart small caps. I mean, you've got to be quite quite weird, I think, to get involved in that because it's regarded as being so volatile and so illiquid and so speculative. But I'm trying to add value on share profits by looking at the smaller cap stuff. If you get it right, there are obviously big rewards here on this call. 0.6 was the trigger, but below that line, which is 0.5. You're risking like a tenth of a penny to try and sort of double or triple your money. So I think there's some value in trying to call these situations. The other benefit of doing this is that with charting, you also have a cue, or you're given an exit point when you've got it wrong. I mean, you have the stop loss there, technical stop loss, which hopefully means that you don't buy at 0.6 pence and allow it to go back down to zero. I mean, you do actually manage the money management part of charting is probably the most important part of it, and you'll get some of the examples of that over the next few slides. Moving to the recent past, African Potash is a stock which I noticed first in August when I interviewed the company. One of the good things about, or the nice things about doing what I do is that I do now interview a lot of the companies I write about, so you get first-hand information about the management and how competent they are, and also the business model. Sort of 4th or 5th of August when I interviewed the company, the share was around, I think, 0.5 or 0.6 pence. I looked at the chart. I thought that looks like a good chart, and really from this point here with this bull flag around the 200-day moving average, that was the key, similar to the Lenny Guess or the LGO Energy chart. And basically I've been calling the shares up on dips ever since. There was obviously the big move there for August and September, and really the 10-day moving average, the green line there, was the stop loss for that. Situation now is that we've got a support line there from August running through the 1.7 pence level, and it looks as though we've got a dip to buy into here. Obviously below 1.7 pence you're out. Initial target at the moment 2.28 pence, which is the 50-day moving average, so retesting basically the October resistance. Obviously in percentage terms, if we hit the 50-day line, that would be a decent return. Other points to note here about this chart are the golden cross that we had in September between the 50-day and 200-day moving averages. That was rather late. And the other point here, which is what I use to time the entry point, is the RSI indicator. Here it's at 40. When it breaks above 50, the neutral level, then that's my cue to go long. If you look here in August, the breakthrough that 50 level was a leading indicator on the shares going up, and then when it fell back below 50, that was a leading indicator on getting out. So from this point here to this point here, the RSI was always over 50. So you buy as the RSI goes through 50, and you exit as the RSI goes below 50. And so in this situation now, if you think, well, I don't actually feel very confident about buying here, I think it's just going to go down, you wait for the RSI to get through 50. If you look here, it's been blocked at the 50 level for the whole of this month. So that would be the thing to watch over the next few days as a cue to go long. That's something that I don't think anybody really uses or talks about. So it's one of the best short-term ways of timing a stock. Normally people look at the oversold or overbought. From my point of view and from what I've seen, going through 50, or going up through 50, going below 50 is the best trigger. The other point is just in general, in doing what I do, I have to get it right. If I get it wrong, I have to get it right as much as possible. If I get it wrong, I just get trolled on Twitter and emails. So it is quite an incentive to get these things right. And so therefore I'm very loyal to stocks which are easy to chart or give clear signals, because it just makes me look, it makes me look good. Obviously if I recommend a share at 0.5 and it goes to 3.5 pence, I look like a hero. If it's the other way around, I don't. So that's African Potash. Next stock is one which has also behaved itself. I met the CEO of the company, I think in April or May. The first sign of the shares rising was the breakthrough the blue 50-day moving average in May. That was a sort of again another LGO energy type of situation where you had a consolidation just above the 50-day moving average, then the explosion to the upside, and basically if you see since then the shares have remained at or around the 50-day line all the way up. There's a support line there from April. So we've taken the shares up from 0.12 or 0.13 pence to 0.5 pence was the target I had. So we just missed that target last month. Looks like there's a new leg to the upside happening now. We've had the RSI push back above 50. We've got a golden cross between these moving averages as well. So that looks to me as though that's going towards 0.57 while we hold above, let's say, 0.35. So a decent, it's sort of spiky, but a decent trend there within that trend, within that channel that I've drawn. So basically, moving averages, the little flag breakouts, and the RSI are what I use. It's not more complex than that, but also being very strict about where it's wrong. So above 0.35 to 0.57. And so that avoids somebody emailing me when it's 0.3 and saying, I bought at 0.4, it's gone to 0.3 and I'm losing money. You should have only lost 0.05, or obviously if it goes up to 0.57, you get out there and you don't wait for the shares to come back down to support. Another stock which is looking very healthy in terms of near-term buy opportunity, very similar to the other, to African Potash and Box Hill Technologies. That's Jubilee Platinum. We're back at a support line here. We've also got the sort of the support towards 3 pence or 2.8 pence, higher than the old June resistance. So that's a plus point there. Same wide trend channel that can be drawn. The only thing missing at this point is the RSI is at 42, so you want to see that back above 50. And then if we can get that, and maybe even back above the 50-day moving average at 3.5, the target would then be 5.5 pence or more over the following 2 months. So basically a repeat of the July-August spike. There you can see that the RSI pushed above 50 here when the shares were here, and then they stayed above that until this point here at the end of August. So the same combination of RSI and the moving averages, or the moving averages as support. Opti Biotics is next. This is a stock I interviewed, I mean, it was quite a long time ago now, but definitely when they were around, I think, under 10 pence. For the first time at the end of last year, and then again when the shares were in the 40s. As you can see from the pattern really that we've had, at no time, probably since December last year, have they ever really looked negative. All the pullbacks have been to previous peaks, so the pullback here was back to that peak, and very shallow pullbacks there. And the moving averages, the 200-day moving average, the black line, rising throughout. Situation now, well, first thing is that the target of 100 pence was hit when the shares were, I mean, that was my sort of final target there on the shares. I think they hit 102. Current situation, a bit of a consolidation. I think there's a risk of possibly going back towards the 65 to 70 pence zone as a worst case scenario. But really anywhere towards 70 pence, probably still a buying opportunity, or 70 pence or below, and to retest that 100 pence level over the next couple of months. What you can see here also, RSI 50, on the dips, the shares bounce to the 50 level, the neutral level. We're at 57 now. So the shares aren't overbought at the moment. As I said, at a guess, it's a bit volatile, but at a guess, somewhere around 70 pence would be the place that the shares dip down to. And at this stage, you're only really back below the 50-day average of 59 pence. And that's going to keep rising, but only back below that would be negative for that situation. Pantheon Resources, again, you can see the sort of, it's never really looked negative. The last buying opportunity same situation, breaking the 50-day moving average, going above, RSI above 50, and from that time on, the RSI's remained above that level. Obviously, we've gone through the roof, but at no time here, I wasn't saying sell here, it's gone a bit toppy. It never looked like a sell. And again, the RSI is the clue, that indicator is the clue. Very, very useful, and makes my day job much, much easier. Obviously, it makes investing much easier as well. But these are shares that have been called up on share profits. They've only been, I've never said sell on any of them over the past 3 months, 6 months. So just same buy all the way, and they've done very well indeed. All right, going forward, that was a bit of history, and it's obviously very easy to be wise, or come up with the best examples after the event. Situation now, audio boom, a bit difficult in terms of the fundamentals here. Still doubts about or delays in the revenue stream, but I'm looking for this support line here to hold towards 3.8 pence. We've had multiple tests of this RSI support line as well. I think that's quite a strong indicator there. So above 3.8 pence, I'm bullish on the shares and looking for them to go back towards the 6 pence zone. Another stock that has a sort of big Twitter buzz. I've interviewed the company as well. Chart, there's not much of a chart here because the company changed its name, but I would be surprised if the shares ever went below 1.2 pence now, and while they're above 1.2 pence, which is, that's sort of the stop loss below 1.3 pence, looking for them to head up to 2 pence. If you're cautious, wait for the 50-day moving average to be broken and then go long, and wait for the RSI to go above 50 and then go long again. So these sort of conditions there, or conditional triggers, I think are useful, and I think, as I was saying, most people don't trade or don't chart small caps, and they don't give you these conditional type of entry points as well, which would be confirmation of a new leg to the upside. Next up is a stock which looks like it's finally going to have its day in the sun. Dekel Oil. Dekel Oil is a palm oil company. I've interviewed them just a couple of weeks ago. Miton Group invested or bought a 3% stake in the company, so there is a fundamental reason for going long. Gervais Williams is one of the best fund managers in the country, so he's decided to invest in this company. So that helps drive a bit of confidence for me. If you look at these two averages here, the black 200-day and the 50-day, they're both rising, and they'll probably cross over the next couple of weeks. That'll be a golden cross buy signal, one of the strongest technical signals there. And also the RSI just bounced off the 50 level as well. So that suggests to me that the dirty work's been done, and above the 200-day line, 1.09, I think we could see the shares up to the top of that channel at 1.8 pence over the next 2 to 3 months. Next stock, Inspirit Energy, the boiler maker, the next generation boiler maker. I called it higher from here, which was again the LGO energy type of formation, the break of the 50-day moving average, a consolidation above it, the bull flag breakout. That took the shares to 0.8. Now I'm looking for a second leg up while we hold above 0.4 pence for the stock to head back up to 0.8. You can wait on the 50-day moving average being broken. The shares were just below that on Friday, and also RSI 50 plus as well. But that's one to watch out for over the next week or two. The other reason I back it as a bull situation is because Tom Winifred thinks it's a sell. So I just have that sort of. I feel sorry for the company when it gets a slap from Tom. Company here, KBC, they're a sort of software company, and they have contracts with the oil and gas industry, which is why the shares took a battering before. But this looks like, I think, a really strong chart. Rising trend channel here, breakout, looking for, sorry, this is Kennedy Ventures, sorry, wrong, I've got the wrong chart on there. Sorry, Kennedy Ventures, rising trend channel there. Already called it up from around the 4 pence level. One of my stocks to buy for the winter. 12 pence target while we hold above 7 pence. Sorry about the wrong names there. Let's go for Tech Capital. Again, very strong chart. This company is an intellectual property company. They've got various patents, diabetes testing and food coating, etc., etc. Met the company when they were down here. They broke the 50-day moving average. Rising trend channel there, above 40 pence. I think they're going up to 80 pence over the next 2-3 months. And how many have we got left of these? Totally, this is a NHS, effectively an NHS outsourcing company. Again, met the company. Looks interesting in terms of trying to save the NHS money, because the NHS is clearly going bust, or just as a sort of a leaky boat in terms of its finances. Here we've got the break above the 50-day moving average, this sort of bull flag breakout. I'm looking for 80, 90 pence over the next 2 to 3 months. 50-day and 200-day moving average is rising, so really, while we're above the 30 pence level, we could see considerable upside there on that situation. Let's see, how many stocks have we got left? A couple of stocks to go. Tern, this is another company that Tom trashed in the summer. There's a video of me getting trashed by Tom on Tern, and him laughing at me, actually, when the shares were 6p in June. Eventually, they went to 29 pence in September. But I just thought, I thought then that the chart looked very positive. This area here, and in fact, they did turn out to be very positive, because that breakout of the 50-day moving average did the trick. They tripled against a rather difficult market. Situation now is that I'm looking for a new leg to the upside here. Probably have to break RSI 50 and break that 50-day moving average at 15.7 pence to take us back to 30 pence. But I think you can probably see, just with the general flow of the charts, very similar, generally similar setups, and I'm looking for the same thing every time. And it obviously helps me knowing the companies or seeing the companies, so I sort of have a handle on where they are at the moment. This was W Resources was one of my 10 stocks to buy for the autumn, which was written at the beginning of September. You can see here, that was published on the 1st of September. You can see that here the shares were around 0.45 pence. And we had the breakout just after that, up to 0.85. I think the target then was around 0.9 or something like that. Looks like we're having another go here. To the upside, they were helped last week by they got a permit on their big La Paria tungsten mine in Spain. And my view now is that while we hold above, let's say 0.55 pence, just below the 50-day moving average, we'll head up to 0.9 pence again. In fact, I think they already went up to 0.8 or 0.85 during the week. So I think on Wednesday, Thursday, they've already gone up. So look for any dips to buy the shares on a technical basis. That's the end of my selection. I've rushed through them. Any questions on the charting theory?
Sorry, I just wondered, when you take a position on these small cap charts, are you actually buying the shares, or are you?
I think given how much I get paid for writing about them, I'm very tempted to do that. I think the problem I have is that, one, you have to declare that you're in them, and two, it's very off-putting to be, either talking your own book or not talking your own book. So at the moment, I don't do that. I actually, if I trade anything, I trade indices or FX, because that's not a market which you're an insider on. So I like the DAX and the FTSE, and this could be for instance, if this is a 5-minute chart of the DAX or a 15-minute chart of the DAX, the principles are the same. So that's what I'm involved in. But people are more interested in the share profits audience are more interested in small caps, so I write about what they're interested in. If they want me to write about the DAX, I'll do it, but it's not the same demand.
Is it easy to spread people?
I think Spreadex do the AIM stocks. Obviously, some situations the spreads are just horrific and it's just a nightmare. It depends. I mean, some of these might be, some of these might not be. You also have the situations that some become more illiquid or less illiquid, depending on the time. But these, I think that most of the stocks here are actually quite liquid because so many people are interested in them.
You've created, these charts you've shown us, you've created a trigger and you've said these are interesting.
Yeah.
Have you also got a range of charts where you've found a trigger, but they haven't in fact on that part?
I think that, well, the point with this is that, which I think is sort of relatively unique to what I do, that I will have 2 or 3 triggers that have to be hit, which are not related to each other. So therefore, your chances of being wrong, with the RSI has nothing to do with the moving average, and the moving average and the RSI nothing to do with support and resistance either. So it's difficult, not impossible, for all 3 triggers to be wrong. So the RSI goes through 50, but the shares don't go above the 50-day moving average, or I try and come up with advice, let's say, where the chances of all the triggers being wrong are very limited. So, in fact, I was recommending this situation here when the shares were 0.45 last week. But I said, the RSI has to go above 0.45. The shares mustn't go below 0.4. So that's what happened. But if they'd gone below 0.4, I mean, that was the end of the advice. So you lose 0.05 of a penny. But it was above 0.4, they could go to 0.9. So that it's risk reward. It's probability or possibilities. It's not guarantees. But you look for the situations where it's already pulled back a lot. It's already halved. They've had their placing. They're waiting for their permit, and if they hadn't got the permit, then obviously, the shares could have gone to 0, let's say. But it's probability, and I think that seems to work. Yep. Sorry? How's it going for you?
Well, initially, using time frames, weekly, daily, 4-hourly, and the hourly, and the result, and then this week, we're patching. So, when you're trading, there's 3 points of trading. 1, where would I find a good book or something to tell you how to get this new book? And when you talk about it's about EMAs, SMAs, and you want it to 50 now. Are you doing 50, 100, 200, 50?
Yeah, well, I think, there's a lot of points there. The first thing, the book, I've written a book, 101 Charts for Trading Success, but that's basically a book of examples, historical examples, which is basically what this is. I think the way of improving and the way of learning is to look at setups which you recognize and you see again and again, and which you test yourself. I mean, there's no other. It is experience. Are there any other questions? Sorry? I can't hear. So I can't. I still can't. Platinum. I think with gold, for me, unless, well, let's say, platinum would be a near-term buy if they don't raise rates in December. That's my stock answer.
And when you've got these trigger points, do you then look at the news to do as much cross-checking as possible?
I think what helps is if you're already familiar with it, where the company is. So here, I was familiar with that they're a tungsten company in Spain, and they're waiting for their license, and they've had their placing. Obviously, with small caps, there's always the minefield of the day the shares go up a bit. It looks like a charting buy, and the company uses that strength to issue a placing. So there is that problem, and there'll always be that problem. But if there's just been a placing, it's a nice, then you're quite, yeah, you're relatively safe. They're not, unless it's Mossman Oil and Gas, where I think they have a placing every 3 days. So, but you're normally safe. One final question.
Do you have a view on what will happen with GKP?
They will go bust unless they get money from the Kurdish government, which is very sad. But I think on that one I'd go with Tom's view. They've been a total disappointment. I think 2 years ago I came up with a 10 pence target, and that was the last time I got a torrent of abuse. And in fact, they blocked me on Twitter. I think they're probably one of the few people to block me on Twitter. So I was a real fan of the company, but it just hasn't worked out. I think they're lucky they're even in business, given the state of the geopolitical state there. It's actually lucky they're still even around. Because, they're just in the middle of a disaster area. Just final question, yeah?
Do you think companies want to claim for at this stage?
No, I'd rather wait for them to be. I'd rather see Glencore double and buy there when I know it's going to survive or it's sorted itself out. The mining sector catching a falling knife. It's kept on falling for the last 4 years. You just can't. It's just not. You're not going to call the bottom there, are you? Anyway, thank you very much, and see you again next time.